Hi, everybody. Thanks for watching. Before we get started, please take a minute to click subscribe to my channel to keep up with all of my latest investing and personal finance content. And please visit the link you see on your screen for a message from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. All right, so I'm here with my friend Tyler Crow, and we're going to talk about some stocks that are beaten down. Now, obviously, there are a lot of stocks in the market that have been beaten down lately, and the real estate sector has surprised a lot of people for how it's underperformed the S&P 500. And in times of rising rates, it's not uncommon for yield-based investments like real estate investment trusts to underperform. But some have done a lot worse than others. A few in particular are down more than half in the past year. And the question is, are these kind of traps at these prices? Are they worth buying? Or will they ever recover? So the one that I'm watching, and it's been on my radar this year, is Innovative Industrial Properties. Ticker symbol is IIPR. This is a REIT that specializes in properties owned by the legal cannabis industry. Think marijuana dispensaries, think production facilities, things like that. So the bull case here is that it's a really fast-growing market. The size of the legal, or in terms of dollar volume, the size of the industry is expected to roughly double over the next 5 years. And these are tenants that generally are willing to sign very long-term leases with annual rent increases built in. They're net leases, 15 to 20-year initial terms, so steady cash flow. The problem is that there's a lot of credit risk involved with the specific tenants. Most legal marijuana operations cannot access the traditional banking system, for example. I know a lot of them out in the Las Vegas area are still cash only, just to name one example. So that's a big risk. If these businesses go under, what do you release the property to? There's a very limited, potential tenant base. It's not like a big marijuana dispensary could just become a CVS overnight. I mean, it would take a big act of capital investment to release these properties. So I think the credit risk is probably the biggest downside here. I think the stock makes sense on a risk-reward basis from this point. I don't think it's going to get back to where it was back in the meme stockish days, where every so-called marijuana stock was, soaring 200 to 300%. But I think it might be worth a look at this level. Tyler, any thoughts?
I share your thoughts on the credit risk, and that's what has always made me apprehensive of the company, just period. The ability to, or their customers or tenants' ability to maintain payments has always been a major challenge for them. We've already seen one of their tenants default. So it's a real risk. And like you said, it's not like these facilities can just be converted quickly to be repurposed for something else. Even repurposing for another grower is not a guarantee either, because of things like they make a lot of concessions, like tenant improvement costs and things like that typically go into facilities like this. So I share a lot of the concerns. I guess the degree to which I'm concerned of them is a little bit higher. But I wanted to bring another one to the table here too, because it's also down 50%, which is Safehold. Now, Safehold is a REIT that specializes in ground leases. They, instead of actually owning any buildings themselves, they just happen to they buy the land from a building owner, the actual land underneath the property, and then lease the land back to the property owner. It's a way of creating a new portion of capital for an individual property. So you have like your debt, you have your ground lease now, and then you have your your equity and things like that. So it's just a new funding mechanism, and it's been a very popular thing. The mortgage or ground lease origination business has been growing like wildfire for them. The biggest challenge for Safehold, of course, is that with ground leases, they are very, very long term, and they are very sensitive to interest rates because they grow at a relatively slow rate, and you have to take on debt to originate all of these leases. And their profit margin is the spread between how much their debt costs and how much these leases cost. With rapidly rising interest rates, obviously that's not a good position to be in right now. Now, what this means in the long term, whether or not this is a buy, I get a little cloudy, right? Like obviously there is a short-term headwind, but it also opens up opportunity for the ground lease industry. More people are with higher interest rates, people are going to be looking for more alternative financing options so they don't have to repay a construction loan that's at 7, 8, 9% 5 years after construction of their property or improvement. So there's kind of like there's that offsetting, I guess you could say offsetting, sorry, we're going to have to cut this, but offsetting forces that one is good, one is bad, and it's hard to see which one will exactly prevail right now. I'm still hopeful because I think it is a very innovative model, and I think it's going to be very popular. But I do acknowledge that navigating a high interest rate environment is going to be very hard for them.
Yeah, I'm a big fan of Safehold too. I like these, I call them bond REITs because they essentially trade like bonds. Safehold's definitely one in that category. And as interest rates come down eventually, whether the Fed starts cutting rates later this year, whether it takes till 2024, whatever, when rates start coming down, the general yields paid by REITs are going to start to come down. And since yield and price have an inverse relationship, the price should go up. I mean, regardless of what the business is doing, right? I mean, this is a very stable business. The business is doing exactly what it did a year ago when it was 50% higher, first of all. It's really, really rate sensitive. And I mean, it makes growing tough. There are some other implications of high interest rates. It makes it more expensive to borrow money, for example, to expand the portfolio. But I'm a fan of these at these levels. I think income investors especially would do really well, getting in at these prices. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.